Hello and welcome to this series on unpacking the world of hedge funds. Have you ever wondered how you could further diversify your investment portfolio and enhance your returns by using alternative assets? In this 8-part series, we will be exploring some characteristics and concepts of hedge funds, diving deeper into what makes hedge funds different to unit trusts, debunking common misperceptions, walking through types of hedge fund strategies, examining the return stories of these strategies in varying market conditions, as well as illustrating the benefits of including hedge funds inside of your investment portfolio. You can look forward to hearing from specialists and portfolio managers within Fairtree, covering Fairtree's unique approach and application within client portfolio construction. Let's begin.
Welcome to part 1 of this series, where we will provide you with a brief overview of the world of hedge funds in South Africa. We will look at standard investment portfolios versus alternative investments, the structure and working of hedge funds, the benefit of including hedge funds in an investment portfolio, how they are regulated in South Africa, and then we will come to a conclusion. While most investors have a fair understanding of traditional asset classes, like equities, property, fixed income, and cash, they tend to be unfamiliar with alternative asset classes. Alternative assets can be best described as a range of unconventional financial securities to invest in, which include hedge funds, private equity, commodities, and even art. Including these assets in an investment portfolio unlocks the opportunity to generate superior returns and can also support social and environmental innovation. What most South African investors don't realize is that they have the wonderful opportunity to include alternative assets in their discretionary as well as their pre- and post-retirement portfolios. So what exactly is a hedge fund? A hedge fund is a pool of investors' money that is mostly actively managed by portfolio managers and their teams. Their objective is to generate optimal risk-adjusted returns for investors in all market conditions. In other words, they strive to gain profits to the degree of risk that must be acceptable in order to achieve it. To make this possible, hedge funds are more flexible than other collective investment schemes like equity and balanced unit trust funds. They can, for instance, invest in shares issued by a privately owned company or use several forms of leverage. We will explore some of the most noteworthy characteristics of hedge funds in part 3, so please join us for that. Portfolio managers may furthermore use an array of hedge fund strategies for the purposes of enhancing returns or protecting the assets against market exposures. These strategies can include long-short equity, short selling, market neutral, arbitrage, multi-strategy, and so forth. At this point, these strategies might sound like foreign concepts. In part 5, we will unpack some of these fascinating strategies to show how portfolio managers use them to achieve their objectives. The question, of course, is how does it benefit investors to include hedge funds in their investment portfolios? Hedge funds provide exceptional diversification opportunities, allowing investors to access markets they won't be able to otherwise access. This additional exposure to alternative asset classes over and above a traditional portfolio can provide investors with good returns even when markets go down. This might sound strange, but as hedge funds typically show a low correlation compared to conventional asset classes, it means that they will behave differently in similar market conditions. Consequently, including hedge funds in an investment portfolio not only enhances the performance of the portfolio, but it can also be used to change the risk dynamic of the portfolio. Later in this series, we will illustrate the powerful effect of including hedge funds in an investment portfolio. Since 2015, the regulation of hedge funds in South Africa has been tightened and should provide investors with more confidence and peace of mind when it comes to investing in hedge funds. Any person managing a hedge fund must register the fund with the FSCA and will be regarded as a financial services provider under the FASE Act. They must furthermore appoint a management company approved by the FSCA to reduce the operational risk associated with hedge funds. In addition, the ASISA hedge fund classification standard was adopted in 2020, helping investors to make a more informed decision when choosing a hedge fund. And lastly, the types of hedge funds are defined by the Collective Investment Schemes Control Act. In South Africa, there are two available types. The first one is a retail investor hedge fund, which is available to any investor to invest in. They typically have a less risky investment strategy and lower investment minimums apply. The second one is a qualified investor hedge fund. These funds are aimed at more experienced or institutional investors who have 1 million rand or more to invest. The key takeaway for part 1 is simply this. Investors looking to diversify their investment portfolios whilst aiming to achieve market-beating returns and gain performance, possibly even in falling markets, need to look no further. Investing in a hedge fund provides access to some of the world's most skilled portfolio managers and opens the door to unparalleled investment strategies and opportunities. Please join us for part 2 as we will explore how asset classes, diversification, and correlation fit into the world of hedge funds.